Welcome to the August 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. And so if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And this month, I want to start with one of the clearest market reversals of 2026. It's called the comeback of value stocks. For the last 3 years, growth stocks have led the market, and we've talked about this, right? The Russell 1000 growth outperformed the Russell 1000 value, you ready for this? By 31.2 percentage points in 2023, another 19 points in 2024, but in 2025, it was only 2.7%. But through July 31st of this year, the scoreboard has completely flipped. The Russell 1000 value was up 20.7%, while the Russell 1000 growth was up just 0.3%. That is a 20.4 percentage point advantage for value in only 7 months. Now, before we go further, here is the quick distinction between the two. Growth companies are generally businesses where investors expect revenue and earnings to increase faster than the broader market. So think about names such as Nvidia, Microsoft, or Amazon. Value companies tend to be more established businesses, trading at lower valuations relative to earnings, cash flow, or assets. So think about JP Morgan, ExxonMobil, or Berkshire Hathaway. Now, those are broad examples, not perfect boxes or recommendations, but they help explain the difference. Now, take a look at this chart. The final column shows growth minus value. So a positive number here means growth led, and a negative number means value led. So for 2026, that number is negative 20.4% since value has outperformed growth. Now, only 2000 and 2022 show a larger full year advantage for value anywhere on this table. And there are still 5 months left in this year. Now, this story didn't just appear out of nowhere. In April, we said dispersion was the next step of the rotation. You remember? We had already been seeing this. Last month, we said the market could be up and still not feel the same for everyone. This chart brings those two ideas together. Rotation means leadership is moving from one area of the market to another. Dispersion means the gap between the winners and the losers is getting wider. And in 2026, leadership rotated towards value, and the performance gap between value and growth expanded to more than 20 percentage points. So, in plain English, what worked over the last 3 years has not been what's worked this year. And this is where active management matters. Active management does not mean predicting every turn perfectly. It doesn't mean abandoning growth or chasing value after a strong run. It means having the flexibility to review concentration, rebalance exposures, and make sure a portfolio is not frozen around the winners of the last market cycle. A portfolio can own several funds, multiple accounts, and dozens of positions, and still be driven by the same handful of growth companies underneath it. That concentration can be easy to miss while those companies are leading, but it becomes much more visible when leadership changes. So the takeaway is that leadership changes and portfolio positioning should be intentional. The market did not simply move higher in 2026. It actually has changed leaders. That's a perfect lead-in to Ryan's market fact, because over long periods, it's not only the market leaders that change. The companies inside the index, they actually change too. So Ryan had a little more than one market fact to share this month, and so he asked if he could borrow just a little extra time and share not just one, but a few slides. And honestly, after seeing them, I understood why. Because this month, the market fact he calls companies change, leaders fade, and innovation never stops. It's a good one. So here we go. We just talked about how dramatically market leadership has changed over the first 7 months of this year, right? But Ryan's fact actually shows what that same idea can look like over 30 years. So I want you to start with this first slide. Of the companies that made up the S&P 500 in 1996, only 135 of those 500 are still in the index today. That's just 27%. So put another way, nearly 3 out of every 4 companies from the 1996 index have been since replaced. That's amazing. Now take a look at this next slide. On the left, you're going to see the 20 largest companies in the S&P 500 at the end of 1996. Would you have guessed Coca-Cola was number 1? That was even before I was drinking like 20 of them a day, too. ExxonMobil was number 2. Intel was number 3. Microsoft, okay, that was number 4. GE rounded out the top 5. This is so cool. Look at the list on the right. As of August 13th, 2026, the top 5 are NVIDIA, Apple, Alphabet, Microsoft, and Amazon. In 1996, the largest company on the list was worth, at that time, $131 billion. Sounds like a lot, right? But as of August 13th, 2026, NVIDIA was worth more than $5 trillion. Technology and communication services companies represented about 25% of the top 20 in 1996. But today, they represent 50%. And of those original 20 market leaders, only 7 remain in the top 20 today. That's crazy. ExxonMobil, Intel, Microsoft, Johnson & Johnson, Walmart, Eli Lilly, and JP Morgan Chase. That is an incredible amount of change in a pretty short period of time. So Ryan, as he always does, he wants to take this exercise one step further. So he's going to continue to go with this. And I want you to look at this final slide. Suppose you had been an exceptional stock picker, the best, in 1996, and you predicted which 7 companies would still be among the 20 largest businesses in America 30 years later. If you had invested $100 in each company and reinvested the dividends, your original $700 would have grown to approximately $25,927. Now, that same $700 invested in the S&P 500 would have grown to approximately $12,550. So that's more than twice the ending value and approximately $13,377 more dollars than the index over that same period. Now, this is clearly a perfect hindsight exercise, right? No one knew and no one could have known back in 1996 what that list would look like here today. But that does not make the lesson any less important here. A relatively small number of durable businesses can create an enormous amount of long-term value. And that's one reason active management matters. It gives investors the ability to continually evaluate individual companies rather than just assuming today's position in an index will remain permanent. Here's just some kind of healthy questions you want to ask yourself, right? Is the business still growing? When you're thinking about investments and you're looking at stocks, is it competitive or have a competitive advantage? Is that becoming stronger or weaker? Is management adapting? Is the valuation reasonable at this particular time? And then is a new generation of companies beginning to take its place? Because companies change, leaders fade, and innovation never stops. The market evolves, and over time, portfolios need the ability to evolve with it. So that brings us directly into the big discussion. Because in artificial intelligence, everyone is focused on which company has the best model today. But as these charts remind us, having the lead today and building a durable advantage for the next 30 years, those are two very, very different things. So this big discussion, we're going to call it kind of the 2 AI races. And I want to kind of step back from all of the daily AI headlines, right? We're seeing them all the time. Almost every week we hear that a new model has launched and a benchmark has now been broken or a different company has moved into first place. Well, ChatGPT improves and then Claude responds and then Gemini releases an update and Grok closes the gap. But the scoreboard is constantly changing again and again. Now that is one AI race. But it's not the only one. There are really two races being run at the same time. The first is the fast-moving race to build the best AI model. But the second is the slower, longer-term race to build the chips, the infrastructure, the operating systems, and devices on which those models will run. Now, the first race gets all of the headlines, right? This is everything you're hearing about. But the second may have just as much to do with where the durable economic value in AI is actually being ultimately created. All right, so go with me on this. Look at the model race, right? An AI model here, as you can see, is the engine underneath products such as ChatGPT or Claude, Gemini, and Grok. Companies compare them across benchmarks involving reasoning and coding and research, science, and other tasks that they look at. And this race is moving incredibly fast, right? It's crazy. On June 9th, Anthropic released Claude Fable 5 and moved to the top of the Artificial Analysis Intelligence Index. Did you even know there was an index for that? This is how they're looking at these things. But there is. And exactly 30 days later, OpenAI released GPT 5.6 Sol. And it finished only 1 point behind Fable 5 while completing the benchmark tasks at approximately 1/3 of the cost. In 30 days, 1/3 of the cost. By August, Grok 4.6 had moved into the same group of leading models as Sol at an even lower price point. That's 1 month. That is how quickly a meaningful lead can be challenged. No single benchmark tells us which model is best for every person or every task. One may be better at coding. Another may be better at research or science or long-running work. But the broader pattern, it's hard to miss. One company moves ahead, a competitor responds. The performance gap narrows. The cost comes down, and then the rankings change again. So that raises a really important business question. How valuable is it, this first place, if first place may only last a few weeks or 30 days? If the leading models continue improving together, benchmark leadership by itself may not create a lasting advantage. Price begins to matter. Efficiency begins to matter. Integration and distribution begin to matter. And ownership of the customer begins to matter. The model may remain a critical component without being the entire product. Now let's look at the second race. Hardware and platforms. This is not the one that you hear about so often. Every AI model has to run somewhere, right? It may run inside a massive data center or through the cloud, on a computer, or increasingly on a device close to the user, your phone. So this race asks a different set of questions. Who's building the chips and the infrastructure? Who builds the devices? Who controls the operating system? And who owns the relationship with the customer? The race becomes more slowly because hardware and operating systems and distribution networks and customer habits, they're harder to replace than a software model. I'll give you an example. NVIDIA's DGX Spark is a perfect example of this. It's a compact desktop AI system designed to run large models and autonomous agents locally. It shows how the hardware opportunity is expanding beyond a single chip and towards supplying more of the system on which AI is built and used. And this is where Apple becomes a useful case study. Because most of the discussion when you hear about Apple has focused on whether the company is behind in AI because it's not leading the public model rankings in the same way as OpenAI or Anthropic or Google or xAI. If that is the only race we are measuring, the criticism may actually make sense. But Apple enters the second race from a very different position. Apple reported that more than 2.5 billion active devices earlier this year. 2.5 billion devices. It controls the iPhone, the iOS, the App Store, and a deeply established customer ecosystem. Its latest AI architecture combines models that run on the device with larger models that run through private cloud compute. And so Apple also says its latest family of foundation models was built in collaboration with Google. So that actually means Apple may not need to build the best model in the world entirely by itself. It can develop some technology internally, partner for other pieces, and then integrate everything into a device, your phone, an operating system the customer, me and you, already uses. And that is really what I want you to think about here, right? ChatGPT and Claude and Gemini can all become more capable while running on an iPhone. In that sense, innovation by the model companies can also make Apple's device more useful. So for an AI company like OpenAI or Anthropic to seriously disrupt that position, it may not be enough to build a chatbot that is slightly better. It may need to build a new device or interface compelling enough to make people leave behind years of photos and messages, applications, subscriptions, settings, and simple muscle memory. Now, I'm not saying that it can't happen. It could. Apple is not untouchable. But replacing an established hardware ecosystem is a much higher hurdle than winning the next model benchmark. The broader investment point is that technical leadership and economic leadership are not always the same thing. A company can build the best model and still depend on someone else for chips, cloud capacity, distribution, or access to the customer. Other companies may supply the infrastructure, control the operating system, or own the device through which the customer is actually using it. So investors should not only ask, who's building the best model today for AI? What else should they be asking? Well, who owns that computing infrastructure? Who builds that device? Who controls distribution? And who maintains, most importantly, the customer relationship? So that's why both races matter, right? There's the fast-moving race for model leadership, which we hear about. And then there's the slower race to own the hardware, the platforms, the distribution, and devices through which AI becomes a part of everyday life for us. Remember, the best AI model may change constantly, but the device in your pocket changes much less often. And this is exactly why investors should be careful about treating AI as one single investment theme. A portfolio can own several companies connected to AI and still be concentrated in one narrow part of the value chain. Model developers, semiconductors, cloud infrastructure, data centers, or consumer devices. Because when leadership is changing this quickly, it can be valuable to step back and ask, is risk balanced? Is the portfolio unintentionally concentrated in one company, theme, or layer of AI? And are we assuming today's technical leader will remain the economic leader? Does every position still have a clear purpose? And that's why we offer our second opinion service. We've seen firsthand how helpful this perspective can be for our friends, our family, and our clients. And we would be honored to offer that same second look if it'd be useful to you or someone you know. So I hope you enjoyed today's Let's Talk Markets. We're always so grateful that you joined. And we encourage you to share this content with anyone who might find beneficial from some of the stuff that we were talking about and staying connected to what's happening in the markets and why it matters, because it's changing constantly. And as you know, we've got all of our replays of Let's Talk Markets posted on our YouTube channel. And if you haven't checked it out yet too, you should. It's our home to our Beaver Nuggets and our podcast Between the Bears and the Bulls. And we actually just released our latest episode with Mike White, the Chief marketing officer for Raymond James. And so make sure it was awesome to go check it out. And I think y'all will enjoy. So as always, if you have any suggestions on what you'd like to see from us, just let us know. We've incorporated things before based on your feedback, and we'd love to do that again in the future. All right, so last thing I'm going to leave you with. Do you know what's faster than an escalator? An escasooner. We'll see you in September for the next edition of Let's Talk Markets. And don't forget, leave it to Beavers.